Hey guys, welcome back to another video. My name is Josh, and in today's video I'll be talking about the two new funds that Kernel Wealth recently announced, and these two funds are the Kernel S&P Kensho Moonshots Innovation Fund as well as the Kernel S&P Kensho Electric Vehicle Innovation Fund. So these two funds are what you call thematic funds, which I'll go over in this video, discussing what they are and how they could possibly fit into your portfolio. I'll also be going over the top 5 positions of these two new funds very briefly to see under the hood what type of companies they are and whether they are profitable companies or not. So I'll be going over those two things, and if you enjoyed today's video, be sure to hit like and subscribe. And as always, this is not financial advice, purely for entertainment purposes only. This is not a recommendation for you to buy the Kernel funds that I will be talking about in this video, and you can read the full disclaimer down in the video description below. And before we begin this video, I just want to caution you guys that there are some imposters out there on my comment section commenting about referring people to a reliable crypto bro.
Bro, what about that Josh Wang guy?
I do own crypto, but I am definitely not a crypto bro, and I won't give my WhatsApp number on the YouTube comments. And as you can see on my actual comments, you can see that my name is filled in with this sort of gray background. So just be careful out there, a lot of scammers, and I hope none of you guys got caught with those scams. So, according to BlackRock, thematic investing is an approach which focuses on predicted long-term trends rather than specific companies or sectors, enabling investors to access structural one-off shifts that can change an entire industry. So, for example, if you believe green energy is the future, then you might invest in clean energy companies that generate their power through solar or from hydro, or you might invest in companies that produce batteries that allow these companies to store their clean energy in. And as a result of a shift towards clean energy, then you should expect to see these companies benefit from that shift. So that is something thematic as an investment. You're not investing in a particular industry, but you're investing across a theme which could cover multiple industries. So the two new funds that Kernel recently launched, the S&P Kensho Moonshot Fund as well as the Innovative Electric Vehicle Fund, are investment themes because one focuses on disruptive innovation and one focuses on innovation within electric vehicles. So the Moonshots Fund allows you to own your share of 50 of the most innovative US listed companies at the forefront of disruptive themes changing our tomorrow. For example, we have Virgin Galactic Holdings, iRobot, Lyft, and more. And over the past 5 years, this fund has returned a whopping 53.4% every year. All right, so that is every year for the past 5 years. The companies within this fund is 50 companies, so that is quite a large number. This fund has a management fee of 0.55% per annum, and that is actually quite low for a thematic fund. And Kernel does have a rebate method where if you have more than 25,000 invested with Kernel, then they will give you a 0.1% rebate. So that could actually drop to 0.45% depending on how much you invest. Next up, we have the Kernel S&P Kensho Electric Vehicle Innovation Fund, which invests in a diversified mix of global companies involved in the electric vehicle sector and the ecosystem supporting it. For example, energy storage systems, clean fuel technology, charging infrastructure, and more. Over the past 5 years, this fund has returned a 36.09% return annually to January 2021. There's 29 companies within this fund, so slightly less than the Moonshots Fund. Same type of management fee involved, 0.55% or 0.45% with the rebate, and the largest subsector in this fund is auto parts. As a side note, you might be wondering, who is Kensho? Now there's 3 names in here. There's Kernel, which is a New Zealand fund manager, and then we have S&P, which obviously does manage the S&P indices. And then we have Kensho here, which sounds a little bit Japanese, but who is Kensho? So Kernel did write a blog about explaining who Kensho was, and Kensho is a Massachusetts-based startup that has concentrated on artificial intelligence and analytics for big financial institutions. And we know that today Kensho leverages S&P Global's data to research, develop, and implement leading AI and machine learning capabilities that drive fact decision making. Together, they have a range of indices including the S&P Kensho Moonshot Index, S&P Kensho Robotics Index, and of course the S&P Kensho Electric Vehicles Index. Now, I'm no rocket scientist, but what it sounds like is that Kensho is an artificial intelligence that picks stock based on a set criteria, which is innovation. So this sounds a lot like the tools that quant hedge funds use to outperform the market. So this is actually quite nice to see that we have some of these tools available for us, for retail investors to take advantage of. And as they say, if you can't beat them, you should just join them. And I think this is a nice way for retail investors to kind of join sort of what hedge funds use to identify their stocks. So that is a side note of who Kensho is. And now let's go over the top 5 holdings of the funds themselves. So now let's talk about the Moonshots Fund. Now I'll go over the top 5 positions within this fund. For each of these positions, I'll briefly describe what type of industry they operate in, what their market cap is, and what they're currently trading at in terms of their price to sales ratio. Because all of these companies are unprofitable at the moment, using a price to earnings ratio wouldn't make a lot of sense. So the 5th position in this fund is FuelCell Energy, making up 3.62% of this fund, stock ticker FCEL. This company operates in the clean tech industry with a market cap of $6.5 billion and a price to sales ratio of 92 times. Coming in at number 4, we have NantQuest, making up 4.39% of the fund, operating in the genetic engineering industry and have a market cap of $4.2 billion and a price to sales ratio of 99,000 times. So this company is generating a very small number for their revenue compared to the $4.2 billion in market cap. In 3rd place, we have the X1 company, making up roughly 5% of the portfolio, operating in the 3D printing industry, a market cap of $921 million and a price to sales of 17 times. In 2nd place, we have Vuzix at 5.37% of the fund, operating in the wearables industry with a market cap of $959 million and a price to sales ratio of 144 times. And in 1st place, we have Microvision, making up a significant 10% of the portfolio, operating in the virtual reality industry with a market cap of around $3 billion and a price to sales of 338 times. So as you can see here, the price to sales ratio for all of these companies are actually relatively high compared to what they generate at the moment in terms of revenue. So from this, we can see that there's a significant premium already baked into the share prices of the top 5 stocks in the Moonshots Fund. And this is also similar with the Electric Vehicles Fund. So as you can see here, all of these stocks in the top 5 positions for the Electric Vehicles Fund also trade at a relatively high price to sales ratio. So very quickly, we have 4.5% of the electric vehicle fund in Tesla, which, as you know, is an electric vehicle manufacturer. We have 4.61% of the fund made up of Workhorse Group, which is a company operating in the auto parts and equipment industry. 4.8.5% of the fund is made up of Ballard Power Systems, which operates in electrical components and the equipment industry. We have 7.5% in Plug Power, which also operates in the electric components and equipment industry, and 12.5% of the fund is made up of Blink Charging, which operates in the automotive retail industry. In terms of identifying an alternative to both of these two funds, there's one that really comes to mind and one that is very popular among investors at the moment, and that is the ARK Innovation ETF. Now, this ARK Innovation ETF is managed by ARK Invest, led by Cathie Wood. Now, I actually bumped into Cathie Wood late last year when I was at Waiheke, so needless to say, that was a very exciting day for her. Now, the ARK Innovation ETF has an expense ratio of 0.75%, and the reason being is because this is an actively managed ETF. So ARK Invest, they do have research analysts researching stocks, which results in a higher expense ratio. Which brings me to the two key benefits of the Kernel funds. So the first one is obviously there is a lower expense ratio with the Kernel fund compared to an actively managed ETF, and the reason being is Kernel is a passive ETF. They essentially just track what the S&P Kensho index does. So they don't do any active research on companies. All they do is just track that index, and as a result of that, that does cut down a lot of the costs involved. The second benefit of the Kernel Fund is that it is a New Zealand domiciled fund, meaning that there is some tax benefits involved. If you do have over $50,000 invested into overseas equities, excluding Australia, then you actually do have to pay another tax called a foreign investment fund tax, a fifth tax. With investing with Kernel, there's not much tax admin on your side because Kernel sorts out all the overseas taxes on their side. So when it comes to your reporting, you don't have to worry anything about that. Now let's talk about how you can structure these Kernel funds into your portfolio. So in a previous video I made, I talked about how you can build a $10,000 portfolio by using a core satellite strategy. You can check out the video in the link above. Essentially, in that video, I discussed what a core satellite strategy is, and a core satellite strategy involves having a core part of your portfolio with the majority of it in a broad-based index fund, making that core. And then you have satellite positions, which are smaller positions that tilt to your portfolio into a theme or an investment trend that you like, so that you get some exposure to that. So for example, you could put 80% to your core and the remaining 20% in ideas that you like, such as the blockchain or disruptive innovation, so on and so forth. So what that does is that your portfolio will largely track the market, and it might outperform in some years if your satellite positions perform well. What this also does is that it mitigates some of the downside risk, because we know that these innovative funds tend to be a lot more volatile because the companies within it are largely unprofitable, and there's no guarantee that they will actually succeed. And also what that means is that performance is very volatile, and that also means share price is also volatile. So you don't want to have the majority of your portfolio in these types of funds if you're more risk adverse, all right? So this is not financial advice, but obviously if you have less risk appetite, then you want a lower proportion of your portfolio in risky assets. At the end of the day, there's a high chance that these companies fail, and most of these companies probably won't ever succeed and grow into the companies that people thought they would grow into. But there will be some within the crowd that actually do that 10x or that 20x, which makes investing in this index fund make a lot of sense, because it's very difficult to pick a winner out of a whole universe of stocks. But there's a good chance that you'll actually pick up a winner by investing in these ETFs that pick out the top 50 companies that they think will do well in terms of innovations. So personally, if I wanted exposure into these innovative funds, then I'll likely be doing this through the Kernel funds, because what that does is that it leaves out, any chance of me picking out a complete dud, and I instantly get diversification into these top innovative companies. Chances are one of them might succeed and the rest all fail. That still doesn't matter to me, because I would only allocate a small chunk of my portfolio to this innovative fund. Personally, no more than 5 to 10% of my portfolio. So let me know what you think about these two funds. Leave a comment down below, and I hope you enjoyed this video, guys. If you did, be sure to hit like and subscribe. Until next time, take care.